Today, we are bringing back a favorite subject, the old how do you spot a lemon when it comes to real estate investments. We are doing a deal sheet teardown. Greg, who is usually a really nice guy, has just taken off his gloves. He's been growing his nails for a month and he's just going to scratch it up like a honey badger. You ready for this, GC?
That was so good, man. That was so good. It never gets stale. We do the show for like 5 years, 6 years now. It never gets stale, man. I
Yeah.
love you, dude.
Yeah, sometimes I just like to let it fly, buddy. Sometimes I just like to let it fly. Well, you better be ready, Greg, because it is time for your weekly edition of the Not Your Average Investor Show. Welcome, everybody. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flows, is a great co-host, and because his name is Gregg Cohen. Say hello, Gregg Cohen.
Hello, everybody. Fantastic to be with you all today.
That being said, GC, let's get into this, man. I'm looking forward to you taking this down. What did you think as you were finding this next victim for your vicious attack?
I love how you portray me as just this guy that's just destroying, scorching the earth.
The villain.
I mean, honestly, I was sitting there. I was sitting at the kitchen table yesterday as and my kids and my wife were coming in the house. My dog was sitting next to me. I'm breaking down the eval and I'm sitting there. And at one point, my wife at this point, been doing this for 20 years. It's hard to get her excited about, rental property investing at this point. She's just lived it with me for 20 years. But at one point, she was making dinner with the kids and I just looked up and I was like, babe, it is like shooting fish in a barrel when we talk about looking at the way that other turnkey companies just fudge the numbers. Every time I do this show, I'm like, oh my gosh, it is like shooting fish in a barrel. So we do have a lot of real life examples. We of course are going to keep all names out of this. We're going to keep all company names out of this. Anything that would be an inkling to describe exactly which company this is, I've kept out of our discussion. But there are so many learnings here that, especially as a new or an investor who has already maybe purchased your first, second, third, fifth properties, there are so many learnings that you can see from a real-time example of an expert who has done this thousands of times, breaking down something else out there. And a couple of things just come to mind when we're talking about kind of the space that we're in right now, the time that we're in, the challenges that we all face with home price affordability and interest rates and whatnot. There was less of a need to fudge the numbers 10 years ago or 15 years ago when it came to a property evaluation. But I've been talking about this for years and years and years now. As home prices go up and as rents go up, and now that interest rates are higher, the property evaluations are ripe for fudging. And that's why you're seeing this happen on every single evaluation that I bring to you guys. I have never, ever, ever in my entire career seen an evaluation from another company that I agree with. Ever. I've seen thousands of them. I have never, ever, ever seen a company that actually accounts for all of the costs. So just understand that some of it is intentional because people want to sell. Some of it is unintentional because people are just not informed. But whichever it is, at the end of the day, the tough thing is that it hurts you as the investor, especially if this is your first investment, because it takes so much courage to get out there and buy a turnkey rental property and put your trust with a company out there. It is such a courageous move. And if you get into a situation where what is represented on the evaluation and what is represented on the client experience doesn't turn out to be that way, it's very likely that you'll have a bad experience, and then you'll never do it again. And you'll go right back to normal. You'll go right back to average, right back to the traditional way to invest. And so that's why I'm really passionate about it. I want to do it in a way where we're respectful and that we can take the learnings out of it. But it's really important to me to help, especially newer investors who are taking that first step, to know what you're getting into, know what to look for, and make an informed decision, because this asset class can do so much good for you and for our communities and for our country. And it would be a shame for your first step to be a misstep.
That was a great intro, buddy. Really good stuff. I'm gonna start calling you GC, the Guardian of Courage. All right, here we go. So this is the presentation the Guardian of Courage has put forth here. How to spot a bad deal in rental property investing. Of course, investors do your own due diligence. This is informative purposes only. Any numbers we talk about here are not a guarantee. It's not a promise of future performance. This is educational purposes and do your own due diligence before you get into something. Anything I missed there, GC?
Well, JWB is not a financial advisor. I'm not a financial advisor. This is not financial planning advice, and just surround yourself with those that you trust before making a decision.
That being said, they are a team that's here to support you through your real estate investing journey. If you have questions about other deal evaluations that you're seeing, we'd love to see them. Best place to go is call JWB at 904-677-6777. Text only 904-293-0341. Send a text, set it and forget it, and everybody will follow up with you. Or you can pick.com. And we work real hard on this, folks. The Q2, Q3, 2025 Jacksonville Real Estate Market Report. If you haven't received that, it's a good one. People love it. So go ahead and either scan this thing or go to jwbrealestatecapital.com/report. All the new folks that are here, you definitely want this thing. Speaking of new folks, chat, what exactly does he mean by turnkey rental property, GC? How do you say that?
I think that's a great question. I'll answer that in just a second. But Pablo, hey, we are getting a lot of like in and out. So I don't know if there's a way to juice up the internet over there or whatnot, but you're kind of going in and out. So just keep that in mind. If I see you just kind of hanging in there, I'm just going to take the reins and start to roll with it. So just a heads up there.
Sounds good.
What do we mean about, or what is turnkey? Turnkey is an experience where one company controls your outcome, really. In real estate, most of the time, the normal way is for you to have multiple teammates, multiple companies, all having a piece in the outcome. And the problem with that is that they all have different goals. Their goals are not aligned. And then for you, at the end of the day, there's not one person to hold accountable to your return on investment. So a turnkey company is one company that is vertically integrated that controls the entire outcome for you. So for example, they have everything from acquiring the property. They actually own the property before they sell it to you. They're not just representing somebody else's property. They build the house themselves. They own the construction company, or they renovate it. They own the property management company. The same person who collects the rent is the same person who sells you the house. That's very important. They don't just refer you to another company. And they build their team and their systems and their company around creating financial outcomes. So for example, they do property management differently than the normal way, because the normal way leads to increased turnover and increased costs. So it's a completely different setup of a type of way to invest in rental properties. And you have completely different outcomes when you do it this way.
There you go. It's kind of like the old, if you are doing a remodel of a house, right? Or you're building something, right? Like you can have an architect and a general contractor and an engineer. And when stuff goes wrong, people are pointing fingers. And then there's a way of doing it. It's called design build, where you just say, hey, this is what I want. Make it happen for me. There is no argument with whose responsibility it is. Everything is under one roof. Incentives are aligned, and it leads to a much better experience when you're doing it that way across anything that you're doing, any kind of delivery mechanism. So that is turnkey rental property investing. And now, what to look for before you actually analyze the Proforma, right? One of the things that we talk about often on this show is the order of operations of the average investor is broken. The average investor will spend all their time looking for a property. The market, it kind of comes a secondary consideration.
So the normal order of operations, as Pablo was saying, is a challenge. And it's one of the reasons why most investors are not. Most investors focus exclusively on the property level decision when they make a decision to invest. Spend almost all of their time there. They generally don't spend much time thinking about any properties beyond their backyard or their city. And so they don't pay attention. They don't analyze the markets. And then they spend almost zero time focusing on the team that's actually going to support them for the investment. But what we understand is that that is a flawed order of operations. Successful investors flip it on its head. So you focus on the team. Then when you find a team that's worthy of managing your money and producing a financial outcome for you, then you go and you understand the market that they're in, and that team will help you understand the market that you're in. Make sure that market has both cash flow and growth and maximizes all 5 profit centers. And then it doesn't have to be in your backyard. Many times it won't be. And then if you do the first step and the second step correctly, the third step is property analysis. And that should be easy, enjoyable, fun. And you should wind up having a feeling of confidence that you're set up for success versus the other way around. That's how to be successful when it comes to rental property investing.
Being said, because of that, this order of operations means that before you even get to a Proforma, you got some questions that you want to ask, right, GC? These are the questions that talk us through these.
Yeah, absolutely. I think it's really important. You can understand if you should even be spending your time analyzing a pro forma and save yourself a lot of time by asking these 4 questions. Number 1, is the company vertically integrated? Number 2, is the market's price appreciation over 4% on average over the last 40 years? Is it over 4%? Is the market's current population over 1 million people living in that market? And is the median sales price for that market under 500,000? All of these answers should be yes. If any of them are no, you should be reconsidering that team and that market. So let's talk about why did I choose these 4 questions? Well, number 1 is the company vertically integrated. Our friend who asked was Turnkey kind of set us up for this early on. And, earlier on in the show when he, asked what Turnkey is. Now, the reason why the team is so important when it comes to this decision is because the way to win in rental property investing is to be in the game, to stay in the game, to invest for a full market cycle. And the only way that you are going to want to invest for a full market cycle, which is known to be between 10 to 20 years, is if that team is world-class and makes this experience enjoyable for you. The thing about rental properties and real estate in general is most people see that you can make a lot of money in real estate, but most people are concerned about the experience. And the thing about it is you can make a lot of money, but if your experience is bad in real estate, people are out. People are out. It doesn't matter that you can make better returns on investment. It can be hard and it can be annoying and it can create issues and it can become a second job. And so people are out. So the reason why you need to focus, number 1, on is this a vertically integrated company, is because that controls your experience. That will allow you to stay in the game and to be able to maximize your return on investment by being in for a full market cycle. The next question is your market appreciation over 4%? The reason why this is important is because as you look at how returns on investment and profits are actually created in rental properties, not all of these 5 profit centers are created equal. There is one profit center that creates the most wealth for you out of the 5, and that profit center is home price appreciation. So it matters significantly which market you choose. If you choose a market that has above average home price appreciation, you're going to see bigger and better returns on investment. If you knowingly go into a market that hasn't appreciated like previous markets, well, you're just going to be leaving money on the table. And the average home price appreciation across the US over the last 40 plus years is 4.6%. And so if you have less than 4% average home price appreciation, you're going to be leaving a lot of money on the table. We're going to take a look at that in our example here in just a few minutes. And the other thing to keep in mind is that percentages kind of make it seem like just a few decimal places, or if just 4% versus 4.6% might not seem like it matters that much. It does. I'm going to show you how much it matters to be in one of those high growth markets, again, because this is an average over 40 plus years. Let's see. Next was, do you have population over 1 million people? This is important because this is about a risk mitigated asset class that also has significant upside. The way that you mitigate for risk is you have a diverse population and diverse economy with many large companies creating the job base here. And if you are in a population that is only, let's say, like 500,000 people or lower than that, you open up the risk for one employer to make some different decisions and then pull out of that market and significantly affect the job base, which significantly increases your risk. So an easy way to tell, is this a big enough market with a big enough job base and diverse enough job base, is just to look at the population. If you have over 1 million people, then you are in a risk mitigated market. And if you are not, you should be looking for a different market. And then is the market's median home sales price under $500,000? This is just a kind of a general number here, but it is really hard to get positive cash flow when you have over $500,000 purchase prices. As you get closer to 400,000, it gets more and more difficult. So if you're looking at markets that are priced over 500,000, just look the other direction. You're not going to be able to get positive cash flow, which is extremely important when it comes to creating risk mitigation for your asset class. So all of these answers should be yes. So what I wanted to do this time is to break down each of these questions, even before we get to the pro forma, and do a little bit of digging like I would do as an expert and show you what to look for. First thing is the company vertically integrated? Well, the thing that I did, I don't know this company personally, that I have their evaluation. I'm not friends with them. I don't know. I just know of them. But what I did is I just put myself in the same shoes as any other investor. And so what you should do is just look at the company's website. You'll get a good sense as to whether or not they're vertically integrated just by looking at the company's website. So this is what I pulled off of their website. And they describe themselves as full service, experienced, and professional. But look how they describe themselves. When buying or selling a home, our dedicated team of top realtors will help you every step of the way. Contact us. Buying or selling, top realtors, right? Experience. We've helped people buy and sell their homes. That's what they are focused on. Professional, right? We bring our A game, buying and selling a home effortless. They are talking about buying and selling a home. They are talking about themselves as realtors. Realtors provide a great service, but a realtor is not a vertically integrated company that you need to buy from. A real estate agent is one part of the team. So for example, at JWB, obviously we're vertically integrated. We have a real estate brokerage within JWB. It's all under one roof. They're describing themselves as real estate agents or realtors, and specifically talking about buying and selling a home. That's what they're going to help you out with. They're not going to help you produce a financial outcome based on owning this asset for a full market cycle. Then they went on to describe the owner. I thought this was really interesting. Of course, I've blocked out anything that would, relate any specific information for this individual and for that company. However, I just pulled a couple of things right off of his bio. This person's career in real estate has been meteoric, and just 6 years after obtaining his real estate license. 6 years ago. Wow. 6 years. Has real estate done pretty well in the last 6 years? Yeah, absolutely. Has it been pretty easy to have a large amount of sales, especially when interest rates were 3% and 4%, for about half of those 6 years? Yeah, absolutely. This person has never experienced a full market cycle. Unlikely this person actually owns any rental properties themselves. Usually you would talk about that when you're describing your experience, and certainly hasn't owned them for a full market cycle. So consider who is advising you. This is very typical for a real estate agent. As I said, they perform a great service, but it is not a vertically integrated company. I talked about all of the awards that this individual has won, which I blocked out just because you could kind of put the pieces of the puzzle together if I shared them. But all of those awards are won in the last year. I mean, guys, like JWB, we win a ton of awards. I don't even share it with you guys every single year. I don't even share them with you. We've won, fastest growing company for 15 straight years. We win best places to work. So if you're talking about the awards that you're winning last year and getting really excited about it, like, it's just a sign that you haven't been in the game long enough to be able to manage the money effectively. So the next question is the market's price appreciation greater than 4%. Well, we're going to be talking about my favorite market to pick on here. Being a Pittsburgh Steelers fan, I love to pick on Cleveland, and Cleveland's real estate market is ripe for being picked on. So that's what I'm going to do. I've chosen an evaluation that happened to be from Cleveland, and so we're going to be looking at the Cleveland real estate market. Cleveland's home price appreciation average over the last 40-something years is 3.5%. And so I think it's important to understand that is a very low average home price appreciation when you're looking at the average each and every year for the last 42 years. And what this does is it leads to Cleveland investors leaving a lot of money on the table at the end of a full market cycle due to this lack of growth. And it's not just home price growth that is slow when it comes to Cleveland. There's other concerning risk factors that should make you go in a different direction than if you're thinking about Cleveland, even before you get to the pro forma. I put Jacksonville here, as you obviously know, that's where my investments are, is where we advocate. Jacksonville is a high growth market, 4.8% home price appreciation, even though our home prices are low, and you can see how the US stacks up here. But Cleveland is low in home price appreciation, low in rent price appreciation. How about population growth? The easiest thing to to understand if you're going to be in a position where you're going to see increased growth over the next market cycle is see if there's demand. Are there people that want to move there? And the easiest way to track it is population growing or declining? Well, population in Cleveland over the last 10 years is declining. It's declined 0.1%. Certainly not growing. So it's basically stagnant. Jacksonville's, on the other hand, is 22%. This is what a high growth, high population growth market looks like. And the US average is about 6.2%. And then income growth. Income growth in Cleveland is below the US average as well. So all of these are signs as to why the next market cycle in Cleveland will not be as profitable, even as, what other markets would be, or potentially not even as profitable as what the previous market cycle would have been in Cleveland when you start to think about these population growth and income growth numbers. Does 3.5% versus 4.5% home price appreciation really matter? It does. And sometimes we fail to see that. But I put the numbers for you. So for a Cleveland, Ohio turnkey property, let's say that you bought, $250,000 worth of properties in Cleveland. Your market value in 20 years is estimated to be about $500,000, which sounds really good. Listen, this model is awesome. We love buying and holding rental properties, but your home price appreciation gains are not nearly what they would be in a high growth market. Just 3.5 versus 4.8% over a 20-year span with, hundreds of thousands of dollars for each purchase. It really adds up. So in Jacksonville, or choosing a high growth market like Jacksonville could earn you over $141,000 more than a slow growth market like Cleveland per property. So bringing this up because if you're starting to see, number one, that this company is not vertically integrated, and number two, it's a slow or no growth market, you should be looking in a different direction. Save yourself some time. The other two questions Cleveland does well on, they have 2.2 million people there, and their median home sales price is $223,000. So that's why people go to the Cleveland market. It's because properties are cheap and low initial investment. That is the reason, along with high positive cash flow. But of course, high positive cash flow doesn't equate to high profitability. You end up leaving a lot of money on the table in other profit centers. So I put together the 7 most common ways that turnkey companies fudge numbers. Here's where we're going to have a little fun. We're not going to name names. We're just going to dive in and take the gloves off. Whatever he said I was going to do, sharpen my nails, honey badger it up. This is what we're going to do over the next few slides here. But here's what I'm looking for. This is what I see over and over and over again when looking at other properties, turnkey companies' evaluations. Number one, they don't include or they underrepresent maintenance costs. Number two, they don't include or they underrepresent vacancy costs. They don't include or they underrepresent certain factors like closing costs, underrepresent interest rates, down payments. Typically, there's something left out there. They don't include or they underrepresent property management fees. Oh yeah, that's a common one. They project higher home price appreciation or rent price appreciation. That's an easy way to juice returns. Number 6, they don't include or they underrepresent selling costs. We want to understand what this investment is truly going to return for us. We have to be accurate about what it's going to cost us to liquidate many, many years down the road, maybe 20, 30 years down the road. But we can't forget to put that in the evaluation, as many companies do. And then they inflate their return on investment calculations by doing something tricky. They include tax savings, principal paydown, and or home price appreciation in year 1 of their evaluation. And we know this is buy and hold. And you don't see all of your tax savings. You don't see your principal paydown. You don't see home price appreciation in year 1 because it doesn't hit your bank account in year 1. Certainly not home price appreciation. You see that when you sell. And principal paydown as well. It doesn't come to your bank account. It just reduces your loan costs. So this is a sneaky one that many companies do as well. So those are your 7. These are all used very commonly. At the end of the day, the reason that they use these is because people believe that higher returns on investment will attract more eyeballs. And, many times that's true. JWB, we think about it differently. We're here to manage your financial outcome. And we need to be accountable to, producing a certain return on investment at the end of your 10 or your 20 or your 30-year hold. And so if you start to play some of these games and fudge some of the numbers, you're never going to show up later on and, earn the trust, continue to earn the trust of those folks that put their trust in you to manage their money. So let's break down this pro forma together here. This is the actual turnkey property pro forma here for this Cleveland, Ohio turnkey property here. First thing, the picture. This is clearly an older home that has hopefully been renovated. Here are their purchase and renovation costs, their assumptions, and then their investment returns. And I know it's a lot of numbers. I'm going to try to make it as easy to see as possible. I highlighted the things that I think we should pay attention to. Number one, the purchase price. Purchase price under $155,000. That's the reason why Cleveland gets a lot of eyeballs. And especially a lot of newer investors are attracted to a market like Cleveland because low initial investment compared to other markets. So that's certainly appealing, but we got to look beyond what the purchase price is. We're looking for value. People invest in value, or people continue to invest in value. Sometimes they invest for a low purchase price, they don't find value, and unfortunately they have a bad experience. So that's the purchase price. But look here, rehab cost. This is their standard pro forma, and this is something just to point out. It's very common in the turnkey space. Many times a quote unquote turnkey company will say that they're turnkey, but it's really not turnkey. Remember, turnkey is vertically integrated. Turnkey is where a company owns the land, they build a house, they put a resident in that home that signs a long-term lease, and then they sell you the home and they do all the management for you. So you don't get a property that needs renovations or a rehab. You are sold the property after that's already happened, and then there's a resident already living there. And this is important for a couple of reasons. Number one, risk mitigation. Who's on the hook when the renovation costs go over? Most of the time, you are. How often do renovation costs go over? All the time. I know this because I renovate thousands of homes each year. That's just what happens. But who bears the cost when JWB goes over on a renovation? JWB does, right? This is about creating a wonderful experience for you as a client. So when you see things like what are the rehab costs in a standard evaluation, their typical way of selling a property is to do a renovation where you're along for the ride. And they put this into their evaluation. So I don't know if they renovated this ahead of time or they just bought this property and then just flipped it to the investor and didn't do any renovations. I think that's probably more likely, and that's more concerning because now you're set up for additional costs down the line as an investor. So warning sign right there. If you see rehab cost or renovation costs and you're thinking about investing in that turnkey rental property, understand that you're going along for the ride. The renovation risk is on you. And then, oh, by the way, there's no chance for you to collect positive cash flow day one because it's going to be renovated for a while. And then after that, it needs to be rented by the property management company. So just some things to pay attention to. Not 100% certain if this has been renovated or not, but you'll know when you look at future evaluations. Assumptions and projections. All right, so there's this rehab cost overrun. They're expecting that rehab costs are going to go over 10%. Again, you're probably on the hook for that. Their vacancy rate, 0%. We're going to talk a little bit more about that. They've got their appreciation rates. They've got their income, which would be rent increases that they expect. They've got their expense increase, which would be things like property taxes, maintenance costs, vacancy costs, all these things that they've got here at 2%. They've got selling costs at 6% of the sales price. That's low because when you go to sell a property, you don't only have the 6% fee that you pay a real estate agent. You also have selling, holding, and closing costs. When you go to sell the property, it doesn't sell day one. You typically have to carry the cost, the mortgage, and other costs for a period of maybe 2 months before the house sells. Those are holding costs. And you also have closing costs on the other side. So the standard way to evaluate that we put in our evaluations is a 10% cost for your selling cost. So this is underrepresented, just like one of those 7 factors that I pointed out. Depreciation period is 27.5 years. Interesting thing here is as I break down how they calculated their depreciation, I'm going to show you how that's a little bit off there. And that's related to this land value thing here. Just keep this in mind. I'm going to break it down a little bit more, but they put their land value here at $0. I'll reference that in just a second. We've got our investment returns that they put together here. And I don't know about you guys, but there's a lot of numbers here. If you put this in front of me and you ask me to put my money into something, I don't know which of these numbers I'm supposed to hold you accountable to. That might be by design. It might not be. But I certainly don't know which number I should be held accountable to. It's confusing. And I think, many times turnkey companies will do this to give themselves an opportunity to flash a really high return number, like 1,250% or 31%, as well as, showing more realistic numbers like this or this, so it's kind of a way for them to kind of like play both sides of it. And, from what I would expect, if there's a salesperson on the other side and you give them the free reign to tell somebody who's going to invest with them, choose one of these numbers to help your clients, like, be held accountable to, well, they're probably going to choose these numbers over here, these higher numbers. You're probably not going to get realistic expectations. But again, I am making a few assumptions there. I haven't been on the sales call with these folks, but definitely watch out when you see many, many numbers. You guys probably know the salespeople probably choose the higher ones. All right, so now we're going to break down how did they fudge the numbers part one. This is this turnkey company in Cleveland, Ohio. This is straight from their Proforma. This is their rental income Proforma. And the first thing I highlighted here is vacancy costs. There are no vacancy costs ever. Not in 30 years are they telling you you will ever have a vacancy. I would love some crowd participation. We have many clients who are here in the audience here. What do you guys think about the chances of not having any vacancy? Or what do you guys think about the chance of having no vacancy for 30 years? I would love to see. There we go. Pablo says 0. So they're renting it to the house to a tenant for 30 years, says the MVP Lee Bishop. Yep, Michael Santorios, that says that would be a 0.0% chance. Saren says 0. Yeah, all right. So, I mean, no other way to say it other than they're fudging the numbers here, right? And this is very, very common. I have heard other turnkey companies explain it this way. Well, you know what? They're buying the property from me, from us. We're not vertically integrated. There's another property management company that we refer to. So my responsibility is to only put in the evaluation what I am selling them, which makes no sense and just goes back to the first question you should be asking. You should be working with a vertically integrated company because that mentality doesn't make any sense. Our job is to produce a financial outcome for you. Our job is to help you maximize this return on investment. And it's ludicrous to think that you're not going to have any vacancy costs. It's a part of the game. But, somebody who's only been investing for 6 years, they might not know that. I don't know if it's malintentioned or it's just lack of understanding. But it doesn't just stop there. There's no maintenance cost anywhere in this Proforma. I looked top and bottom, and there's no maintenance cost anywhere. Again, I could poll the audience. You guys know this. For those who own rental properties, you are going to have maintenance costs. You want to work with a provider who explains this to you, puts it in their Proforma, prepares you for it. And then when it happens, you're not surprised. This is how JWB clients are able to hold on for a full market cycle and see the value of this beautiful asset class. It's because there's no surprises. But when you invest in this company's property in Cleveland here, you are definitely going to be surprised. You're going to be surprised when vacancy happens and when maintenance costs happen. All right, next, we've got no tenant placement fees ever. So if you run the calculation here, this number is 8% of the gross rent. They charge a 8% property management fee, which is low. You probably get what you pay for, but let's just say that that is a standard level of service. Under no circumstances do they ever increase that property management fee, meaning that there's no tenant placement fees and there's no lease renewal fees ever. So they are truly banking on you buying this asset, then putting one tenant or resident in that home, and that resident staying there for the next 30 years, you never having another resident. Because if you had another resident, there would be another lease tenant placement fee. Oh, no, by the way, they're assuming you're never going to have a lease renewal fee, which well-run property management companies charge a lease renewal fee. So again, fudging the numbers, no other way to say it. And then here, they're underrepresenting the increase in operating expenses. And here's, you can kind of see it here. It says operating expenses 2%. JWB expects a 3% increase into the operating expenses. Just operating expenses are things like, property taxes, insurance costs, property management fees, right? But it also includes a couple other things that they're not counting on here. It doesn't include maintenance costs as well. Maintenance costs also should have a 3% increase on them year over year over year. you're not seeing any maintenance costs here, and you're not seeing the 3% increase on operating expenses on those maintenance costs. So I know I'm getting really into the numbers here. I kind of like it because you know me, I'm kind of a data nerd. I hope it's not too numbers driven, but I want to arm you guys with what to look for as you're going out and you're buying properties. You should know what to look for here, and hopefully this helps you be educated for what not to look for. But it doesn't stop there. We've got part 2 here of how they fudge the numbers. We've got our home price appreciation. This is interesting. Most turnkey property companies budget on the high end. But those who are inexperienced or don't know how to evaluate their home price appreciation in their market sometimes budget on the low end. So they actually were too low on their home price appreciation. They don't have access to the same type of information that JWB has, where we pay a hefty amount of money every year to our consultants to be able to give us the data, not just for the Jacksonville market, for every market out there. And so this company seems like they just put a number out there, and they're actually too low. Their market appreciation is actually 3.5%. They're only at 3, sign of an inexperienced operator. Rental income and rental increases. You can see here they chose 2%. They're actually too low on that as well. I think it's 2.6 or 2.8% is what you see in the Cleveland market. So an inexperienced operator there. And I got really into the weeds here, and I won't go completely into it, but ultimately their depreciation expense is that's the tax savings component. It's a big part of the tax savings component. They underrepresent they overrepresent the tax benefits by doing a couple of sneaky things. One of the ways, when you are estimating what tax savings should be, you have to separate land from building costs, because the IRS code allows you to depreciate the building. So in your property, there's both land costs and building costs. Makes sense, right? Well, you have to separate the land costs, because if you depreciate everything, you're depreciating land. Land doesn't break down. And so you have to separate that. If we go back to the first slide, if you saw what their land value was, they put it at 0%. Well, they're overrepresenting the tax savings because they are depreciating land. And in addition to that, their calculation's incorrect. I spent a lot of time trying to get to this number. And really what you do is you take the purchase price. Generally, you knock off 10% of that for the building value. And then you divide that by 27.5. That number doesn't add up here. So I'm pretty sure their calculation is incorrect. I don't have their formulas, but I couldn't make any sense of it. So there's your part 1 and part 2 for how they fudged the numbers. And I don't know if we got 3 Q&A. Let's see what we got here. Zahirul, new name. Welcome to the show, Zahirul. He asked, most of Florida, the appreciation is more like deflation, especially in the West Coast and also in Jacksonville, where most of my rentals are. All right. And so, okay. So let's talk about that. I'm not sure what the question is, but I can just kind of comment on that a little bit. You know, there is a lot of misconceptions when it comes to home price appreciation. The most important thing for home price appreciation is to evaluate it over a full market cycle, because this is about buying and holding. And so short term, 1 year or 2 year or 3 year home price appreciation is the least most important part of the equation. Because higher interest rates have been here for longer, ultimately that is dampening demand, and you are starting to see some home values decrease. Jacksonville is a market where we see about 1.4% home price decline so far this year. Now that could change. But all that's happening here, and Zahirul, I hope you continue to come back, because, and I really hope that you download this, go and request this market report. You're going to learn so much by going there. Go to jwbrealestatecapital.com/report. I broke down what that decline means and how this is actually a great time to invest, because ultimately what's happening is it's dampening demand, but it's not eliminating it. We look back in history at other times where there were high interest rates, and what we saw is that home sales were down, home values were lower, but then what happened as soon as interest rates went low again, got lower, you saw home sales rage back. You saw home price appreciation come back at very high levels. And again, detailed a lot of that in this report. So I would encourage you to download that. Again, you can go, there you go. Johanna put it in the chat here. That's a great learning opportunity for you, Zahirul. And thank you so much for being a part of the show. And then HTTN asked, is this a repeat show? Did you have this info in a previous show, maybe a month ago, or am I flipping? You are flipping a little bit. We haven't done this show in over a year, actually. I believe it was, I went back and I looked. I think it was about a year. So we have done this concept. And about a month ago, what we did is we broke down and built a portfolio for a client. That might be the show that you're thinking about. But this one has fresh data, a fresh eval, and it's new as about a year ago. And the bishop, the MVP says, why do you suppose they're lowballing the numbers? Well, you know, Lee, at the end of the day, they're doing that because they believe it helps them sell better. And it's a short-term mindset. And it does increase sales for people across the country to have a short-term mindset, to inflate the numbers. You know, but at the end of the day, people choose to come back and reinvest based on the experience and on the value. And if you take shortcuts and you inflate the numbers, you are setting yourself up to lose people's trust. They're not going to come back to you. So our approach is, let's just show everybody what it is. These numbers are great. You know, when you actually talk about them and show them for what they are, they're still really good. They're not 16% and 31%, but that's not real anyways. You know, so our approach is, let's just show everybody, because again, when you're vertically integrated, you're not just buying and selling. You're not just helping people buy and sell. You are managing outcomes. You're managing experience. So great questions, guys. You can keep them coming. I'm going to keep going as well. So what I thought we would do is rerun their pro forma with correct assumptions. And so that's what I did. The other guy's pro forma showed that they were going to earn $294,000 from this one property over a 20-year hold with an estimated rate of return of 16%, 15.6%. I chose that one as the most kind of realistic return out of the plethora of returns that they chose out there. So 294,000 with a 16% rate of return. When I reran their pro forma, used all of their numbers and just actually calculated things the right way and put in things like maintenance cost and vacancy cost and used their accurate home price appreciation and rent price appreciation numbers, which actually boosted their returns, is a very different story. Their profits are about $80,000. So not 294, just about $80,000 for this property with an estimated rate of return of about 11%. Very different. Very different. And again, I hope you guys are seeing why many people go to a place like Cleveland, work with an inexperienced operator, take that leap of faith, do this one time, have a bad experience, and are out of the game, trying to avoid that. Hopefully this show helps do that. Then I said, all right, well, you guys are the investors out here. Why don't we compare that to what is currently available for JWB here in Jacksonville, working with an experienced operator that is vertically integrated in the right market that has both cash flow and growth. Let's see what's currently available, and then you guys get to decide which is the better investment. So this is currently available. This is the home on Eaton Avenue. Many of you in the audience here, I just know by your names, have properties right around Eaton Avenue in 32211 zip code. And it's one of our 4 key neighborhoods in Jacksonville. And you can see here, purchase price of $280,000, initial investment of $103,000, right? If you go back to the other property, I think it was about a $50,000 or $60,000 initial investment for the Cleveland property. So why do people go to Cleveland? Because it's less to get in, but it's more costly in other ways. If you invest in the right team in the right market, your initial investment will be about $103,000 here. Estimated rate of return, including everything I just pointed out that other people don't include, including everything, it's still 10%. It's a 10% return on investment. But now you know going in, you're not surprised and you're set up to have a great experience. And here, the home is rented day one. It's brand new construction, already built for you, already rented. You close on the home, you're earning positive cash flow day one, and it's got a long lease term. The resident is signed for a 2-year lease term. So I'll just bring it to you as we kind of close out the show here. You know, which is the better investment? This is the profit analysis for a 20-year hold. We've got the Cleveland property up here, not exactly a looker. You've got your profit broken down by your 4 profit centers, 4 of the 5 profit centers. The only profit center I left off is inflation hedging. But here are your 4 profit centers, and your total profits are $80,000. Or you could invest in that turnkey rental property in Jacksonville. and your net rental income is positive, your tax savings are positive, your principal interest, excuse me, your principal pay down blows away the Cleveland property. Look at your home price appreciation, and your total profits are over $150,000. When we talk about Cleveland leaving a lot of money on the table for property, this is what we're talking about right here. So, guys, I know we missed Pablo on the show.
I'm here. I don't know if I'm ruining things by speaking. I've been here the whole
Oh, you're
time.
good. You're good. You're back in
Maybe you
action.
unshare the screen right now, GC, and you can just
All right.
focus in on me crying. Um,
There you go, buddy. What did it feel like just watching as an innocent bystander in the background?
but I'm always first of all, this is my biggest fear come true. So once I got over my extreme anxiety of what's happening, I can't help but marvel on just how you killed it, dude. Like I just, just kind of kept rolling. You went through it. Everybody should know Gregg is extremely uncomfortable with public speaking, and I'm not just a strategist here. I'm also his security blanket. So once you rip it off, it's a very uncomfortable thing, which he completely went through, right? Like I'm not joking. Like we're laughing about it, but I'm not joking. I think you pushed right through it, man. I thought you did great. You hit on everything that we thought to talk about, and I hope everybody appreciates the effort that you put into this and the prep that you put into this, so that even when your security blanket gets burnt alive, feeling terrible about himself, you continue to deliver value to the community, man. And the community, of course, supports you and adds great questions and takes part of it.
Thank you very much. Thanks to everybody for helping me get through it. It is a big challenge for me. I always try to be vulnerable, and it's not easy for me to speak publicly. I talk with my kids about it all the time. I'm like, you just got to push through. But you know what? When you are passionate about something and when you're surrounded by such a supporting audience and community, you literally can't fail. Pablo, you've told me that time and time again. So thank you guys for helping me get through it. And I hope everybody really learned something. Again, this is one of the presentations I'm most passionate about. I wish every, especially new rental property investor in the world could watch this presentation, learn from it, and then go out and decide where they're going to invest. I think it would change lives if that would
Yeah.
happen. So yeah, I'm glad you guys enjoyed it. I think we'll bring it back. I think a little bit more often. What were we thinking about doing it once every like 3 or 6 months or so? Three
Yeah, I think
months?
we should do this at least once a quarter. Like I always like underestimate how good this is, right? Because you always find like there's nothing like the idea of finding an example and teaching on it. And what we've learned, which we had last week's show on and this week's newsletter, is the idea that while this show, while JWB and the vertically integrated turnkey experience is perfect for first-time investors, what we get is a lot of second-time investors because they've burned their hand on the stove of going through a bad experience, realized the true order of operations, went team first, found the best team in the country, and then now are having a great experience. But that great experience started a couple years late, a couple $100,000 later. And, I think all these teaching moments, whether it's someone's story or the eval that somebody might be looking at and teaching them how to ask better questions, is really important to changing the order of operations in people's minds to help them truly value this thing and, create not your average experience for people, make that the standard.
Well said, brother. I love how we're putting the shows like more thematically together. I know you and our team, Johanna, everybody has been working together to kind of like have one show kind of lead into another. And I hope it's kind of landing with the community. You can see we started with the quarterly market update, and then we went into how can you use that to choose the right portfolio. And we broke down and actually live demo how would I choose a portfolio for you. And we ran some scenarios there. And then we said, okay, well, how are people kind of going down a path, but how can you screw it up, right? What are the mistakes that people can make? What are the bad experiences? And we had Allie on, from our team doing that. And now it's like, okay, well, what does it really look like to objectively put a pro forma together that might be flawed? So hopefully you guys are seeing it. We're always tinkering, trying to improve the show, and we do it because we love you guys and because you guys continue to show up. So thank you guys for being here. And if you wouldn't mind, tell a friend to join you the next time. We would love to build the audience with people just like you. So thank
I'm
you
looking
guys.
forward to being back in studio with you next week, GC. Any piece of advice until we see everybody again?
Don't be average. See
Don't
ya.
be average.